This is Wall Street Week. I'm David Westin, bringing you stories of capitalism. Whether it's DEI or electric vehicles or the rush to southern Florida, every week we see some crowded trades getting reversed. We tell the story of what happens when the bandwagon everyone jumped on suddenly slows down. And drill, baby, drill is another theme of the Trump administration. But it's not at all clear that the oil companies and their shareholders will be joining in the chant. But we begin with the big story of the week for global Wall Street.
You see weaker growth but higher inflation. They kind of offset. And also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored.
Larry Summers of Harvard is our special contributor here on Wall Street Week.
He should be focused on the fact that we had a shock that pushed inflation up and growth down, and that's a bad supply shock. That's a self-inflicted wound, and it tells us that policy is moving in the wrong direction. And it's a shot against the bow of the Trump tariff policies, which clearly have materially changed the picture in a way that the Fed is seeing both as more uncertain and more problematic on both their key objectives.
I was struck by the fact that in the projections, the growth projections were taken down, not just for 25, but 26 and 27 as well. On the inflation side, it was really mainly in 25, and you heard Chair Powell say maybe the effects are transitory, using that word we've heard before.
I would have thought the chairman would retire the word transitory. That is perhaps the most notoriously ill-chosen phrase of his excellent 7.5-year run as Fed chair. And so I was astonished to see him resurrect that concept. He might turn out to be right, particularly if the economy suffers a recession. It's conceivable that the economy won't suffer a recession and he'll turn out to be right. But it's certainly not something that I would want to bank on. There's another point that I think most observers have missed, which is if you look at the dot plot, the median, the person in the middle on interest rates, has not changed. That's what everybody's highlighted. But the average, if you just take an average of everybody's forecast, that's moved up a fair amount in the last few months, reflecting the fact that with these tariffs, with the inflation they're bringing, there's less confidence on the part of the Fed that they're going to be able to cut rates, even as there's a prediction of more cyclical weakness in the economy. So this is clearly a more worrying picture than we had in December, and there's only been one important change, and that's been the change in tariff policy and, more broadly, the political approach to economics.
One of the themes throughout what Chair Powell had to say was uncertainty, because there's the concern about what is being done. There's also the concern about what we don't know around the corner. We have an enormous uncertainty. What does that do to the economic machinery in and of itself?
Nothing good. Look, the task of policy is to reduce uncertainty. The task of policy is to give confidence about sustainability. When policymakers are confidently promising a stock market boom when they come in, and then they deliver the 11th fastest correction in the last century, one of the fastest corrections in the last century, and then they discover that they think the economy needs some kind of detox, and they don't give any indication of whether it's going to end, and they vow unprecedented levels of protection to be declared on a date in the future, that is introducing uncertainty, not reducing uncertainty. And I think that's really quite dangerous.
I am struck, Larry, that as we talk about what the Federal Open Market Committee did, we're talking about the White House almost exclusively. And talk about more broadly what we are seeing coming out of the White House, how it is could affect the economy. For example, this week, we had the president say, I'm going to dismiss 2 sitting FTC commissioners, even though they're an independent agency. So concern that might extend into the Federal Reserve. What are the ramifications throughout the government and the economy of the actions we're seeing?
Let me speak very directly, David. We are not there yet. But every week for the last 2 months, the risk of an attempt to impose authoritarianism in the United States have gone up. The dismissals that you mention are one example. The lawless cutbacks of spending are another example. The impositions and threats to universities with no process, nothing of what is required in Title VI law is another example. The steps with respect to expelling people who are here without the process protections contained in law are another example. The assertion that if the president does it or to help the country or save the country, it can't be illegal is another example. The flirtation with fascists abroad, such as the AfD in Germany by the vice president, is yet another example, and there are many more. We have not crossed a Rubicon yet where court orders are being defied. That hasn't happened yet, but we are getting much closer to that Rubicon. The so-called Overton window of things that are seen as possible and imaginable has broadened. And ultimately, that is going to be alarming for what America is, and therefore potentially going to do grave damage to our economy and the world's. We are not there quite yet, but I have to say what was a possible concern 2 months ago now seems to me to be a genuinely alarming prospect. And that should disturb and worry every investor, and our country's leaders in the business and financial community who know how much they have depended on the rule of law should be organizing to resist what could be a extraordinarily damaging long-term change in policy. It takes decades to grow a forest and a few minutes to burn it down. Something like that is true with respect to our nation's credibility and commitment to rule of law. And so I do not remember in the last 50 years a more alarming moment in terms of the approach that the U.S. government is taking to our democratic institutions.
One way that President Trump says he'll get inflation down is by producing more oil. But those doing the producing aren't so sure they want to go that way, no matter what regulatory relief comes their way. That's next on Wall Street Week. This is a story about irony. For years, the oil industry complained about all those federal regulations that kept them from pumping more into the market. Now they have a president who wants to give them what they've wanted. And our colleague Alex Steele has the story of why they may be having second thoughts.
As the Rolling Stones say, you can't always get what you want, and President Trump wants energy companies to produce more oil.
We will bring prices down, fill our strategic reserves up again right to the top, and export American energy all over the world. It's called Drill, Baby, Drill.
One of the pillars of President Trump's economic plan is ramping up U.S. energy production. Pump a lot of oil, lower gasoline prices, people have more money. Citi says that oil at $60 a barrel and the U.S. economy could see as much as $100 billion of a deflation impulse.
I always say people may not know their ATM PIN number or their anniversary, but they know to the cent what gasoline prices are that day. And it's really because it's the only price that we see written in 10-foot-high letters.
The problem is, people might want lower oil prices, but oil producers want returns.
At the end of the day, oil is a business. Companies have to make investment decisions based on what they think is a price that they will be able to achieve for this product that they bring on.
Saad Ram is the chief economist at Trafigura, one of the biggest commodity trading companies in the world, and it's his job to forecast prices.
Dallas Federal Reserve just recently did a survey of the companies within its region, mainly the oil producers, so asking what do you think average break-even prices are for the different plays. And ultimately, the lowest one came in at about $60. So really, anything at 60 or below is really going to then impact decision making and the profitability of these investments. Even when oil prices averaged $80 last year over the course of the entire year, really crude oil production really only grew about 200,000 barrels a day. So that's telling you that even at $80, which is a much higher price than that range, companies are not deploying a huge amount of capital.
This time, oil companies will prioritize shareholders' returns over most everything else, unlike last time when things ended with a spectacular crash in oil prices, bankruptcies, and burned investors.
We were all caught up into Wall Street and the multiples that were being paid. It's like it reminds me of the tech side now. And so it was the same thought process that went through our minds back in, called it the 2010 to 2019 time period. Pioneer was trading at 10 times EBITDA back in 2012 to the 15 time period.
Scott Sheffield was CEO of Pioneer Natural Resources for over 20 years until he sold the company to ExxonMobil for $60 billion. He's one of the original wildcatters, a risk taker who drills for oil in unproven areas. What led to the massive amount of exploration and development? Was it also cheap money?
We went public in 1991. The reason you go public is to be able to raise capital. We ended up raising probably 5 to 6 billion, probably more than top 1 or 2% of all public independents, to acquire opportunities, to grow. And then eventually the shareholders said, Scott and the rest of the independents, live within your cash flow. So create a free cash flow model that returns us dividends, returns us buybacks, and live within that cash flow to be able to move forward.
Sheffield and others like billionaire Harold Hamm were credited with the innovation, technology, and perseverance that led to the shale revolution, unleashing a flood of American oil into global markets.
You know that going in, there's a certain amount of risk there, but you could also be rewarded greatly. As we took a lot of risk with the Bakken, 1.3 million acres, and so that paved the way, that paved the future.
In 2008, oil prices spiked to $140 a barrel and mostly stayed between 80 and 100 between 2010 and 2014. Capital markets were wide open and companies took advantage. U.S. independents raised a whopping $371 billion in debt.
We had Arab Spring, so we were in the $100, $110 to $120 range. So at that point, people were saying, great, future barrels at those prices, but with a break even that is, $50, that spread is enormously profitable.
The oil came fast, as did the cash, and neither lasted. U.S. shale has a quick initial production and a steep production decline. When shale oil is first produced, it's like the opening of a fire hydrant, a ton of oil really fast. Once that initial flow subsides, the oil slows down. In order to keep the same net amount of oil flowing, producers needed to keep pouring money into new wells.
You had to produce, basically just holding leases. So you had to drill. So it wasn't whether you liked it or not or wanted to, but you're trying to perfect those leases that you've taken on. So did that always serve shareholders? I think it did, because you was preserving the future for them. But some of them didn't see that. They wanted immediate returns.
When oil prices crumbled, the party ended.
I think the washout really was that drop in 2014. So we went very rapidly from about $110 down to, at one point, I think it was, the low was about $28, right? So imagine any industry where that happens, but in particular in a capital-heavy, capital-intensive industry that has long lead times where you have to invest over a period of years, that obviously really, was the reckoning behind that.
Equities tanked. The XOP, which tracks publicly traded U.S. oil and gas producers, lost over 90% from its peak in 2014 to trough in 2020. High yield spiked to almost 22%, and there were more than 200 bankruptcies.
We came down very, very sharply to the point where we weren't just below break even, we were getting to what we call cash costs. So basically just the amount to keep the lights on. There was certainly a lot of loss of shareholder value, which is why I think shareholders are now saying, if you're making money, I'd prefer you return it to me now.
Shareholder pressure can be stubborn, and so is economics.
I think ultimately it is inflation across everything. So whether it is materials, whether it is labor, you're starting to see those things move higher. And I think ultimately also you're seeing a lack of that talent coming into the industry. But you also then look at what's happening around increased costs around steel, potentially tariffs having an impact, and all of that starting to add up.
There are things that could help producers drill at $50 oil. Lower taxes, less regulation, cheaper federal land leases, and less perceived hostility from the government. Natasha Kaneva is global head of commodities at JP Morgan.
We do believe that it can happen. So first of all, the $50 is a target. Yes, at the moment, if you look at the break-evens, they're at about $55. What the administration can do, they can bring the cost of production, the cost of drilling lower. So we actually believe that 45 is the new 55. So we believe that they can bring the cost of drilling by about $10 lower.
Kaneva gets there in three ways: lower royalty fees on production on federal land, corporate tax reduction to 15% on things produced domestically, and bringing back the bonus depreciation from the 2017 Tax Cuts and Jobs Act. This lets businesses deduct 100% of certain capital investments. That alone could cut break-evens by $9.
Yes, they have this additional $10. What they can decide is they can say, okay, we'll pay ourselves more dividend. We'll increase the dividend yield. We'll increase the buyback, or all other things that they can do with this money, or they can say half of that actually will go into the ground and will increase production. So this we don't know. What we're saying is that we believe it's doable.
Kaneva says you don't need to spend that much money to produce more oil.
Our numbers are showing that $1 million spent today versus 2014 gives you about 86% more production. So pretty much you're doubling production through efficiency gains.
The math says producers can drill more with less. Now shareholders have to let them.
Now, maybe it takes a change on the part of shareholders to then say, actually, what we do want is to go back to production growth. Because production growth obviously ultimately that's future revenue that's coming in. And I think we've been in this period where they're not valuing that production growth. And partly it may be because of concerns around peak oil demand.
So if President Trump could incentivize long-term oil demand growth past 2030,
that might change things. Whoever's in the White House has a bigger impact on the demand side of the equation than on the supply side of the equation.
If more oil production isn't the answer, an alternative for President Trump might be gas, baby gas. In a recent speech at the Premier Energy Conference CERAWeek in Houston, Texas, the Secretary of Energy, Chris Wright, mentioned LNG or gas 8 times and oil only twice. It was a fiery speech that had industry leaders abuzz.
President Trump immediately ended the pause on LNG export permits. Today, I can announce our 4th action in this regard, improving the Delfin offshore Louisiana LNG export terminal.
Oil gets all the headlines, while U.S. natural gas production also sits at a record 107 billion cubic feet a day, up 90% since 2008.
Scott Bessen's the three-point plan is considering, yes, it's about 3 million barrels per day of oil equivalent growth between now and the end of 2028. So we actually believe the true number is closer to 4 million barrels per day of oil equivalent. Majority of that would be done by the gas, actually. It's not by the oil, but by the gas.
It's a lot harder to export natural gas. You have to freeze it in order to ship it, with a similar process on the importer side. Those facilities are expensive to build, but more and more are coming online, helping to expand America's potential. By 2030, the U.S. should have over 250 million metric tons of LNG export capacity a year, based on current regulatory approvals.
I think LNG has a great future. It could be more focused on NGLs, liquids, and could be more focused on the natural gas side versus the oil side. We don't have many oil plays left in this country.
The biggest problem for producers, either oil or gas, is infrastructure, moving the hydrocarbon from the wellhead to the Gulf Coast or your local utility. The permitting process is pretty much hated by all energy folks, oil, gas, and renewable alike.
Permitting is difficult for many different reasons, but one of them, it's not in my backyard. And because of that, there's a lot of those environmental considerations that need to be solved for and decide exactly how you approach that.
Many pipelines have been scrapped or held up in courts for years, leading to bizarre pricing, like $20 gas in the Bronx versus $3 gas in Chicago.
It's crazy. I mean, you get some markets that, even get into a negative market. If you can't get your product to market, it does distort it in a lot of different ways. And it also distorts it to the consumers.
If we think away from drill baby drill, what's something better? Is it gas baby gas? Is it dig baby dig? Is it build baby build?
The reality of that is that if we want to achieve all those targets that the Trump administration put forth, yes, and it's a lot of that, bring inflation down, yes, we have particular objectives in terms of trade, we have particular objectives in terms of geopolitics, so it's definitely drill baby drill, it's definitely dig baby dig, it's produce baby produce. We have all of that in the ground, but we need to be able to move that.
Maybe the Rolling Stones were right. You can't always get what you want. But if you try sometimes, you'll find you get what you need. And in this case, what we just might need is more gas drilling and pipelines instead of oil. In that case, everyone wins. Shareholders, President Trump, and us.
Coming up, getting on the bandwagon just as it's coming to a halt. We bring you the ironic story of three trends: electric vehicles, DEI, and moving to southern Florida. This is a story about getting on the bandwagon, something that feels so good when everyone is doing it, but that may get awkward when people start jumping off. Electric vehicles, diversity, equity, and inclusion, and moving to southern Florida have all had their time in the sun, but all are now seeing some shade coming their way.
The historical track record for automotive startups in the United States is extremely bad. The only two American car companies in history that have not gone bankrupt are Ford and Tesla.
Traditional automakers followed Elon Musk in betting big on EVs. In 2021, GM announced that it would end production of all of its gas and diesel-powered vehicles by 2035 and go fully electric by 2040.
Well, I think the car companies were responding with enthusiasm and hope for the new vehicles.
Mary Nichols is a believer in EVs. During her tenure as the chair of California's Air Resources Board, she implemented the state's landmark greenhouse gas emissions standards.
Here in California, the sales rates are almost equal now to gasoline-powered vehicles. In other places, the penetration is going more slowly.
As much as California may be the EV leader, the rest of the country doesn't seem to be keeping up. It turns out that the EV bandwagon needs some support from an infrastructure for charging the cars that just isn't there yet.
It's just that the hope had been that they would really overtake gasoline vehicles faster than they did. And it turned out that there was more reluctance on the part of people, especially in parts of the country where they don't have the infrastructure in place for supporting those vehicles, particularly where the electric utilities didn't step up as fast to provide charging, where building owners in some cases were reluctant. It takes a lot of changes in the system to match what has been achieved over 100 years.
BNEF estimates that the 14 automakers who set ambitious EV goals for 2030 have trimmed back their expectations from 27 million vehicles that year to 23.7 million. One of those pumping the brakes on EVs is Ford, which shelved its plans for an all-electric 3-row SUV last year. CEO Jim Farley took us through some of the challenges several months ago.
Well, first of all, the electric market in the U.S. is about 11% of the market. In California, it's a third of the sales. So it's a huge market and is growing really fast. And competitively, globally, I think what's happened is we're in the mainstream customer. And the mainstream customer is totally different than the early adopters. The early adopters, we didn't need to convince them to go charge, or they didn't really worry about resale value, but the customers now do. And that means on us, we have to really transform our cost.
And now it's not just the lack of charging stations that's slowing the move to EVs. We have a new administration in Washington that appears to be reversing the nation's pro-EV policy.
We ended the last administration's insane electric vehicle mandate, saving our auto workers and companies from economic destruction.
It's a trend that I think is well underway, and it's going to continue. I do think that the election sent a message that in some states in particular, this is like a political issue, which certainly is not helpful for any industry. I don't think vehicles are partisan. I don't think there are Democrat or Republican vehicles. You're just looking for the best vehicle that you can get for your money.
Whether powered by electricity or gasoline, the bandwagon of DEI was moving full speed ahead in much of corporate America when BlackRock CEO Larry Fink wrote to shareholders in 2021 that he had a, quote, long-term strategy aimed at improving diversity, equity, and inclusion. 4 years later, Fink was writing to BlackRock's staff saying it was, quote, committed to creating a culture that welcomes diverse people and perspectives, but acknowledging, quote, significant changes to U.S. legal and policy environment related to DEI.
Now, the real question is, what are the policies and practices that organizations should have in place in order for the organization to function effectively? And we spend a lot of time talking to employees and looking at trends across corporations.
Tracy Sitzman is professor of management at the University of Colorado, Denver, and has studied DEI policies throughout corporate America, why we have them, and which ones work and don't work.
And the clear and consistent trend that we're seeing is that employees want to work for an employer that's authentic in their approach to dealing with their employees.
Sitzman's studies have led her to the conclusion that whether a DEI program makes a company run better and ultimately make more money depends on how it is done.
One of the most popular programs for enhancing diversity and inclusion has been diversity training. And this is an example of a program that can work really well or can undermine our workforce. People work hard, they diversify the workforce, and it's successful. By contrast, many corporations implement diversity and inclusion training, and they have a legal undertone as part of the training. So they teach people just how questionable their behavior can become before it crosses the line to being illegal. And when we implement training with an illegal undertone, it actually results in people's behavior becoming more questionable.
But can a program targeting diversity, equity, and inclusion succeed without focusing on identity politics, without setting targets that become a form of quotas? Robbie Starbuck is a faith-based investor who has championed the cause of cutting back on DEI programs.
Even if you wanted to pretend DEI was ultimately a good thing, how can we do the things that we proclaim to want to do without violating the law? And at the end of the day, if you look at these policies like racial quotas for hiring, it's not possible. You can't have a racial quota for hiring and not violate the law. But therein lies the real core of almost every DEI policy in America, is that we should look at people and judge them by their skin tone, which is diametrically opposed to the ideas of the civil rights movement, which was that we're not supposed to judge people by their skin tone. We're actually supposed to look at them as an individual and say, your value lies in your actions, what you can do, your merit. And so that's what we want to see.
Sitzman may not favor quotas, but she readily admits that it's awfully hard to drive diversity, equity, and inclusion without setting numerical targets.
What strategic goal would you set in a corporation where you would not measure it? It just doesn't make sense, right? Without a goal, without some numbers behind something, we don't know how well we're doing, and therefore we're not going to be managing the process towards hitting that target.
In addition to the bandwagons heading toward EVs and DEI, a third movement was Wall Street's migration south to the sunnier and less regulated pastures of Miami. It began earlier, but when the pandemic hit in 2020, its speed picked up. From 2020 to 2021, Florida experienced the largest uptick in registered independent advisors and broker-dealers of any state. And by 2022, it had become home to Elliott Management, Citadel, Icon Capital, and expanded footprints from the likes of J.P. Morgan. Michael Schvo is a luxury real estate developer with properties in Miami and New York.
What's interesting, because that moment in Miami was an extremely surreal experience. You'd have billionaires roaming around North Bay Road, Palm Island, Star Island, looking for homes and literally willing to pay anything just to find a house on the water. Because the idea was nobody with means wanted to stay at home locked up here in New York City. And obviously today, hindsight, things haven't really worked out exactly like that. People moved to Miami. Miami turned to be a real city because you have now real restaurants, you have real people, you have education, you have culture there. But it didn't take the place of New York like a lot of people predicted.
The growing pains come in the form of lack of schools, unfinished offices, and traffic.
So there's a lack of schools in Miami. There's no doubt about that. And that's kind of the main issue. Infrastructure depends where, right? Miami Beach, sections of Miami Beach are okay. But because you have houses there, there's not real main infrastructure issues. The infrastructure issues really became more apparent in transportation. Crossway didn't have enough lanes. There was a lot of traffic. There was congestion because the amount of cars all of a sudden in Miami, people that are coming to work in Miami, is something that Miami has not experienced. And the acceleration of growth was so quick that they did not have the infrastructure. They're catching up now, but again, now less people are working there. So both the infrastructure is catching up, but we're seeing less people there, at least on a permanent base, from what we thought we're going to have, post-COVID.
I wonder the role of demographics and people moving in both the commercial side, the office, and also the residential that you're involved in. Because if you look at the numbers overall, California's losing people. Illinois is losing people. New York losing people. Florida, gaining people. Texas, gaining people. Does that tell you something about those real estate markets?
Well, yes and no, because it depends who you're gaining. Because if we're talking about commercial real estate, the reality is, are we losing the companies? Are we losing the workforce that's here? Or are you losing, people that are retired and not working and decided it's better to retire in Florida because the tax situation is better there, which is a lot of the reason that you're seeing, people move out of New York and California. There's obviously tax incentive to move to some of the southern states. So I don't think we're not seeing the movement of the true workforce.
Those moving to Miami may have gotten a better climate, but they weren't looking for much different in the spaces they occupy.
So the difference between tenancy in Miami and New York, and again, as I said, Schvo operates only the super prime real estate. So for us, we focus on the psychographic of the tenant. And in our mind, the psychographic of a J.P. Morgan, is no different in New York than it is in Miami. Maybe the office needs are a bit different, a little bit more outdoor space in Miami. There's that desire to have kind of the indoor-outdoor spaces. But the reality is that you don't change your mindset from a service perspective, from a space perspective, from an environment, because you're in Miami or New York or in San Francisco to that effect.
Whether it's picking up stakes and moving to Miami, or ditching our gas-powered cars, or changing the very nature of our workforce, there's all sorts of good ideas out there, ideas that may make sense. But no matter how good the idea, it pays to have a pretty good sense where that bandwagon is headed before we jump onto it. That does it for us here at Wall Street Week. I'm David Westin. See you next week for more stories of capitalism.